Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding. Sitting next to Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. Hey, if this is the first time that you are tuning in, be sure to check out all of our content. Follow me on Twitter at Focused Compound. And then be sure to check out our app, www.focuscompounding.com/app. $7.95 a month. You get access to our 200 plus backlog of podcast episodes. And then also Jeff and I are uploading frequent videos. I actually have about 4 videos that we are going to record today after we get through these podcasts. So
yes, you also get a 2,000 word article from me every day.
And then you also get a 2,000 word article from Jeff every single day as well. So lots of content. Such a value investment, if you ask me. $7.95 a month. So be sure to check that out. Focuscompounding.com/app. So a lot of people have reached out to you that you've told me asking about Bank of America.
Correct.
And the reason behind that is because Buffett has upped his stake in Bank of America. I think that's really the only stock that's been like public that he's really like purchased or raised or added to since
I don't know of
anything
anything else recently. Yeah,
it's certainly not enough to the point of where he would have to like amend a filing or anything like that. But he did buy more Bank America, I think about a week ago. So naturally, a lot of people have been very curious about it and just curious about banks in general, and especially how that, you know, how they're trading. And you said on a recent podcast that you think if you bought like a basket of banks, that you think that they'll do, you know, pretty good over the next 10 years. I think you said that on a recent
I think banks
podcast.
are the cheapest. Banks are one of the cheapest industries. I've looked at some small things in energy and retail and stuff. There's some very small retailers and energy producers and stuff that are cheap too, but severely distressed. Banks aren't distressed.
So we have Bank of America pulled up on Quick FS. We'll try talking out loud as fast as possible for people that are listening on the podcast side. If you do want to sign up for Quick FS, make sure you tell them that you came from Focus Compounding. Currently trading, I'll round up at 11 times earnings. Let's see. The return on equity is about 6%. 10-year median returns of return on asset is about 1%. Revenue has gone from $51.5 billion in 2010 to $48.8 billion in 2019. So there's been a little bit of a decline there. Let's see, but it looks like earning assets have a 10-year CAGR of 1.6, and then something that you pay a lot of attention to, deposits have grown at a 10-year CAGR of about 4%. Have you ever actually looked pretty deeply at Bank of America? I know you actually recently wrote about it on one of your Focus Compounding Dailies, just kind of talking about if you want to like use it as an example to, you know, reverse engineer Buffett and stuff like that.
Right. I have not looked very closely at Bank of America. Of the biggest banks in the U.S., I've looked more at Wells Fargo and JP Morgan in the past. The only big bank that I've looked at in great detail, I would say, is Wells Fargo. In terms of reading the 10K and the FDIC things and things like that. JP Morgan, I've read their annual reports and things. I guess if you count US Bancorp, I've looked at that too, and that was a Buffett holding, but more US Bancorp and Wells Fargo than Bank of America. And there are reasons for that historically, but not necessarily now. Things have changed at Bank of America, but say 10 years ago or something, there were things about Bank of America that made it out, so I wasn't interested.
Like what?
Well, not 10 years ago, I guess. Well, maybe 10 years ago, but a little bit before then. I didn't like the management that was in place and some of the things that they were doing. They acquired some things and they were in some businesses that I didn't like as much. And since then, since Buffett's investment and stuff, they've gotten out of a bunch of things, have focused on a business that, you know, the core business that they're in, and they're maybe more similar to Wells Fargo now.
Got it. Okay, so when you're looking at like a big bank like Bank of America, what are some things that you would be concerned about? Like, what are the drivers to investment?
Right. So here's the easiest way to do it. What's the 10-year median ROA?
10-year median ROA is 0.6%, so just under 1%.
Okay. And then what's the price to book?
Price to book is 0.8.
Okay. So price to book is low, and then the median ROA is low. However, the median ROA is important for 2 reasons. So there's 2 factors here. One is the amount of leverage the bank uses. And the thing is, all banks have used very low leverage for the last 10 years or so. And we could look at that loans to deposits. So if you just look at loans to deposits, that's kind of a good gauge of it. The other way is earning assets. The way I would prefer to use it is earning assets to equity.
So he actually has that right here, capital structure.
Yeah.
It says 6.8.
Right. So 10 would be more normal in normal times, historically.
Okay, so what does that mean?
So it means they're only leveraging up about 7 times. Their ROA times 7 is about the return you'll get historically for the last 10 years, whereas times 10 makes more sense in terms of how the bank should be structured and stuff. So the reason for that, you can see in loans to deposits probably. So if you go to loans to deposits, do you see that ratio? And is he doing it as loans divided by deposits? Is that the way he's doing it, or deposits divided by loans?
Let's see. It's loans. It's LLR divided by loans.
No, that's loan loss reserves. So just go to the line loans divided by deposits. Loans to deposits is a percentage down there. It'll be between like 60 and 100 a lot of the time.
Where is this at? I'm sorry. Let's see. Earning assets to equity, earnings per share. Here we go. Loans to deposits, 69%.
The 69% is very low. Now, there's some banks who've gone lower than that. In the middle of the crisis in Texas 30 years ago or so, Frost was under 40%, significantly under 40%. That's why they didn't go under. When every other bank, 9 out of the other 10 top banks did go under.
Yeah, it looks like in 2010, they were 96%.
Right. And so in 2010, that's coming down from earlier. So if you look at what do they have over there on the right, is that return on equity? What do they have on the graph that they show for the last 20 years or so?
Correct.
Yeah. So you see how return on equity used to be really high, then it dropped lower and it stayed low since then. And that's why a lot of people don't think banks are attractive, because they think, okay, there's a new environment in which they won't have as much leverage and they won't have as much whatever sorts of things, stuff like that. I think that's unlikely for a few reasons. One, government policy. The most stimulative thing the government can do right now is to take off all limitations on leverage, let banks go crazy, lending as much as possible. That's the main reason why expanding the Fed's balance sheet doesn't do much for the economy, is because it has to be transmitted through banks to small businesses and medium businesses and even pretty large businesses. And so without doing that, you're not going to get a lot of stimulation of the economy. You're also not going to get a lot of inflation. But that's one part of it. The other part is just that these things tend to be very cyclical. We were talking to a banker before, and he was saying how in his entire career until about after the 2008 crisis, he never had the problem of lending out all of his deposits. And then that became the biggest problem for him after that. That was never something he considered in his career would be a problem. He was doing CNI lending in Texas and had been for his whole career, and never had a problem until the last 12 years. And since then, every bank's had a problem. So all of them are under leveraged. So they're all under earning their potential. Now, the other thing with Bank of America is that the ROA part of it is also under earning. So if you want to think about like a DuPont analysis, what is your pre-provision, pre-loan losses? What are you making? And then how does that translate into ROA because of your loan losses? And then how does your ROA translate into your ROE? If you can get a double whammy, if you have a situation in which a bank looks like it's earning very little ROE, because one, it's under leveraged, ROE divided by ROA is low because its assets divided by equity is low. And we saw that. It's 7 instead of like I'd say 10 or something was what it might have been 2 decades ago. And then the other factor is, are their loan loss reserves high in the past? And if they were, that's I don't want to say one time, because Bank of America could find ways to make bad loans again. But let's go through the loan loss reserves and what years they were.
Sure. So loan loss reserve to loans. That line, 2010, 4.3, 2011, 3.6, 2012, 2.6, 2013, 1.9, 2014, 1.6, 2015, 1.4, then it just continues to decline. 2016, 1.2, 2017, 1.1, 2018, 1%, and then 2019, 0.9%.
Okay. So it depends on what categories they're in, and they'll show you that if you look at like the 10K and stuff, probably. Those are extremely high ones in 2010, but this is a little confusing because Bank of America, if they're doing meaningful amounts of mortgage lending is very weird, residential for the more plain vanilla sorts of things. What happens is you have no losses or very low losses for a long time. And then you have very high losses in terms of charge-offs and things. And then it goes away again. And that's what happened there. It's similar to like agricultural lending. So if you look at agricultural lending, there's like fraud and mistakes that companies make. But other than that, there's like 2 huge bubbles set off by like 50 years or something. U.S. mortgage thing, same thing. Huge losses in after the 29 bubble, huge losses after the 2008 bubble, 2007 or whatever. So you have that kind of thing, which is different from like CNI, which we could analyze because each recession you'll have meaningful losses in it, or some other riskier things, whatever riskier, but whether it's RV things or stuff like that, we'll just see more regular losses all the time, credit card things, stuff like that.
What do you think is like a good return on asset for like the average, I guess, for a bank and like a return on equity?
1 to 2% return on assets, and leverage of, depends on the situation, but 8 to 12 times levered that up, I would say. So it depends on the bank. And some banks will have situations where they might want low leverage because of some of the things that they're doing. On the other hand, some will have high. Let's look at BOH, Bank of Hawaii. I think will use higher leverage than Bank of America. Let's look at that. So what's their 10-year median ROA? Give me the 10-year medians on like just all of them, basically.
Yeah, 10-year median on ROA 1.2, 10-year median on ROE 16% if you round up.
Okay.
10-year, it's trading 11 times earnings, 10-year median margins. I mean, what else do you want here? I mean,
yeah. So they're maintaining a leverage ratio of about what is that? That's about you said, what was the number?
For return equity?
Yeah.
16%.
16 versus 1.2. Okay. So there you go. So that's very meaningful. So that's they're doing that about, they're leveraged up over 10 times all the time. So let's see, what was the lowest that they went in terms of leverage on earning assets divided by equity?
Let's see. The lowest they went to looks like 12 in 2010.
Okay. So the way they're doing that is they have a dividend, right? But they're mainly doing it through buybacks. So that lets them maintain their capital situation, which is very important for a bank. So a bank's returns will be poor if it gets itself overcapitalized, because the leverage will come down that you would have naturally. So you can see the ROA here at Bank of Hawaii, I don't think in normal times is actually better than Bank of America. So the return on equity is much higher, right? We have a return on equity advantage of like 10% over the last 10 years over Bank of America. But why would Buffett like Bank of America? Because I honestly think it's as good as Bank of Hawaii in terms of the actual deposit franchise and things like that. Bank of Hawaii just didn't make the mistakes that Bank of America did make. And some of that's just luck because they happen to be located in Hawaii. And some of it is that they didn't acquire stuff.
How would you judge a CEO of a bank? Because I feel like the only CEO of like a very large bank that you ever hear anybody talk about is Jamie Dimon. And I actually just tweeted out a podcast that you sent to me that was like an hour long. He was talking about a lot of different things. I tweeted out, be sure to check it out. It was a really good listen. But what are some things that you would like, how you would judge a CEO of a bank?
I think that's pretty hard. Of a big bank, I think a CEO of a bank it's not a position where they're likely to have a big effect on the return in the stock. Okay, it's pretty small. So a smaller bank, big effect. But at a bigger bank, much less effect. A big diversified bank, I don't think that who runs Bank of America or JP Morgan or whatever is necessarily that important, or Wells Fargo or any of those. It matters for some things. They have weird things that have to do with government regulation and perceptions of the company and stuff like that. They make some capital allocation decisions that we didn't get into, but each of these very big banks have some different areas to the bank. And so that's a little complicated. These aren't pure banks. So like JP Morgan is in probably like 4 different things, I would guess. I mean, depends. If you count government things that they do too and stuff, then even more. But they basically have like an investment bank. They have like a wholesale commercial part to their business. They have more of like a similar to a regional bank. So more similar to Wells Fargo with most of their businesses, and more similar things we talk about like Frost and Prosperity and stuff like that. And that's really the best part of them. And I think they break that down sometimes. Some of their businesses have fairly low returns or require a great deal of leverage, like investment banking and stuff requires a great deal of leverage. So it's not as good a business as like the core banking that you see at the retail part of their business, which is good.
How would you think about the valuation of Bank of America? So 11 times earnings, return on equity is 5.6%.
It's very cheap.
So like, how would you go through though? Like, Okay, I get
So
it.
I don't care about price to book. Most people do, but I don't. But we can use price to book as a way of doing this. The way that you could do it for price to book is that you just do two assumptions, mainly two assumptions. You just need to know what you think loan loss reserves should be normally, and then you need to know what do you think leverage will be normally. And this is where it would get very controversial talking with people. What tends to happen is that banks have very long cycles because interest rates have very long cycles. The cycles here are about the same length as like shipbuilding. Interest rates and shipbuilding are pretty similar. So almost 20 years is the kind of cycles that you would see. So and that's just a general thing. It could be a 40-year cycle. So for a lot of people who spent their career on Wall Street or something, they've only seen falling interest rates, really. They've never seen rising interest rates. They've generally seen falling inflation, things like that. So because of that, it feels like you're going to have a period where returns are very low and people aren't going to need loans and things like that now. And then you had boom period before that, right? And so things have permanently changed in banking and stuff. I don't really believe that. I just think this is the kind of thing that happens all the time. And if you read books on the early 1950s and periods in the 1940s and stuff in banking, right after the war, it doesn't feel that different to me than now. It feels pretty similar in the things that people would say. So I just think that you're going to have a more normal leverage ratio eventually. In fact, it might happen really fast because of COVID. We've seen that. I mean, some banks have grown their balance sheet 20, 30% in a quarter because of COVID. And that is going to result in a big increase in leverage. But
because of the PPP loans?
Yeah. Mm-hmm. Yeah. And also because everyone drew all their credit lines. Mm-hmm. So, you know. And so if we look, let's see. Loan loss reserves now are running at about 1%. Mm-hmm. It's kind of normal. I mean, I don't know enough about all the different categories that they lend in and stuff. There'll be extraordinary years where those reserves are a lot higher or charge-offs are a lot higher than 1%. But like in most years, I wouldn't be surprised if they have about a 1%. So that's what you'll see. But I just want to warn people once every 10 years, it'll hit 4% or something weird like that. So when you actually average it out, it's not as good as it looks right now. But say 1%, then what are they leveraged at right now? They're earning assets divided by equity.
Let's see, earning at 7 times.
7 times. So they could go to 10. So if they went to 10 times, that would mean that you're talking about that's like a 40% increase, I think, something like that. So you'd be about 1.4 times higher. And then we have, let's see. So what's their ROE as of last year?
Let's see.
Most recent year. Let's do their ROA.
The ROA it says 10-year median returns.
Well, let's just do last year.
Return on assets, 1.1. Return on equity last year, 10.3.
Okay. So I would guess it would be about 15. So it would be about 15%. So a normal year for Bank of America in the future should be about 15%. Mm-hmm. Their banks are also fairly protected from inflation and stuff like that. They earn their earnings in cash pretty quickly. Most of their portfolios roll off pretty fast, turn back into cash, things like that. So they are more protected than other things from inflation. Not that inflation is good for them or something, but that's a possibility.
Are you surprised that Buffett added to Bank of America instead of Wells Fargo?
No.
Is that because of everything that's been going on with Wells Fargo over the past couple of years, or what? It's trading more expensive.
I think Bank of America, I think stuff has happened with Wells Fargo, and I think Bank of America is much cheaper. Mm-hmm. Bank of America seemed to me to be pretty cheap for a pretty long time. Mm-hmm. Yeah. And it seems to match how Buffett invests in banks, which is he does the adjustments for the two things that we talked about, basically. So he adjusts for the amount of loan losses. So for instance, when he bought Wells Fargo for the first time ever, he bought in a year in which they reported basically no earnings. That's typical. Let's see. Type in PKBK so I can show you an example. Let's see if it goes back far enough. So that's Park Bank. What is their what were their loan loss reserves in 2010?
Let's see, loss reserves 2010 2.3%.
Okay. So here's the problem. So we don't have enough data on this one. The problem is there's a difference between charge-offs and loan loss reserves and some other things like that. And we're not going back far enough, but they had some pretty serious loan issues there. They, as you can see, have higher loan losses all the time, right? Mm-hmm. Or they reserve more.
Yeah.
Because they're making riskier loans, basically. But this is a good example, I was going to say, because this stock was very cheap. I don't know if you can get a stock chart, but going back to like 2009, 2010, that even 2010, that's just a 10-year chart will probably be enough to give you an idea. It was a very cheap stock. So what was it in 2010?
2010 looks like in the 4 area.
Okay. And what was their reported earnings per share in 2010, or their reported, if we go back there?
Let's see, EPS in 2010, 72 cents.
Okay. So there you go. So that means that there were, what is that? That's 5 to 6 times earnings. So it was pretty cheap then. And that was in a period in which everyone would have assumed that banking would recover more and more. So you're getting 5 to 6 times earnings, and then you're expecting earnings to recover a lot. Now is a different story, right? But that's the kind of thing that Buffett would buy or something, is when they have that period where their loan loss reserves are kind of high, or their charge-offs are high at least.
And it's currently trading at 5 times earnings today.
Yeah, which is probably for a different reason, which is probably has to do with net interest margin and stuff. But yeah, and what's the stock price?
Stock price is $11.69.
Right. So you have something that's almost triple probably from the bottom of whatever it is, and it's still trading at like 5 times earnings. Banks are very cheap right now, I think, because of people's concerns about the net interest margin. I'm not sure exactly why, though, in the case of Park, because the weird thing is that Park actually doesn't have very high non-interest bearing deposits. It gets its deposits more from like time deposits, like CDs and stuff. And so because of that, if short-term interest rates are very low, and the bank still is able to make loans further out that are a pretty steep curve, then it's actually going to make a lot of money. So we talked about that with some banks, where some banks actually benefit from the fact of if very short-term rates are cut. And the Fed has much more control over very short-term rates than very long-term rates. What you'll see happen in terms of like rates that people don't want to go up going up is it won't be on the very shortest part of the curve. It's easy for the Fed to control that. It's much harder for them to control things further out. Like actually what banks pay each other to borrow and to deposit money like overnight and stuff is something that's very easy to control. CDs to some extent, stuff like that. But the stuff that won't be easy is like what actually can a corporation borrow at for 5 or 10 years, which is what matters more to banks usually, or at least to this bank, it does matter more. So that's how you figure out with that Buffett might have bought something like that back in 2010 or something. And I bet he would buy a lot of banks today if he could. He's somewhat limited on that. You can look at like JP Morgan. He did buy some JP Morgan. He had owned it personally. I mentioned US Bancorp. He's owned a company that he is on MTB, the Buffalo Bank, and things like that. But he's limited in terms of how much he can do of a really big size, and that's the biggest thing I would say. Is if you look at Bank of America, what's the market cap on that?
Bank of America has a $218 billion market cap.
And I wouldn't be surprised if one day it has over a $500 billion market cap. I mean, like if you were just appraising it as to what it probably is worth, it's probably trading at 50 to 70% of what it's actually worth, like in normal times. I don't know if we'll reach normal times or what those are, but it's certainly as a stock that he could own and have a position in, it could be a well over $500 billion worth that eventually.
Cool. Well, I want to thank everybody so much for tuning in with Geoff and I on the Focused Compounding Podcast. If you're watching on YouTube, make sure you hit the subscribe button. And of course, if you want to get access to all of the other content that we talked about at the beginning of the podcast, Geoff's 2,000-word write-ups, some videos, and then, of course, the podcast backlog, go to focusedcompounding.com/app and be sure to sign up. $7.95 a month helps. Everyone likes this old line. Helps keeps the lights on of everything that we're doing. We're definitely very appreciative of it. I want to thank everybody so much for tuning in, and we will see you in the next podcast.